Okay, hey guys, what's going on? Um, for today's lesson, we're going to be talking about market indices. So let's get started. So first things first, the definition. What is and what are market indices? So basically, a market index is a tool that helps investors measure the overall trends in the stock market. And it's used to help compare current prices with previous price points to make decisions about whether to buy, sell, or hold a stock. And it helps track the overall performance and health of the markets. And yeah, you can see here there's the S&P 500, the NASDAQ Composite, and the Dow Jones Industrial Average. And in this video, I'll also be talking about the NYSE Composite. So now you might be asking, now why are these um, market indices important? Well, they're important because they help decide the overall trend and overall pattern of the stock markets. For example, if the market indices are showing that, yeah, mostly everything's in a bull trend, which means that, mostly stocks are going up, they're gaining value, then investors might want to invest in more positions. But if most of these uh, if most of the stock market is in a downtrend and lots of things are losing value, then they might want to take fewer positions and keep more of their cash as cash instead of in a position and in a stock and in a company. So yeah, as I said before, today we're going to be talking about the four major indices, or what I believe to be the four major indices, and that is the Dow Jones Industrial Average, which is this one, the S&P 500, which is this one, the NASDAQ Composite, which is this one, and the NYSE Composite Index, which is this one. And you can kind of see that they're all they're all measuring sort of like the overall health of the market because they all have a very similar pattern. You can see, um, well, we're right now in the middle of a pandemic, and you can see the effect of that on all of these, where they have this huge sell-off down here, and you can also see trying to build back up with government giving out stimulus checks and all that stuff, and you can see that, sort of trying to build back up there. So yeah, they are different, and I'll get to the differences later, but overall, they track basically the same thing, which is just the stock market. So that's why they look so similar. So let's get to our first one, the Dow Jones Industrial Average. So it is an index of the overall markets, and it tracks 30 very large blue chip companies that trade on the NYSE and the NASDAQ. And one point to say about all of these indices is that the growth and loss that that is the growth and loss of the indices. So, for example, it gains when you're talking about a stock, you're saying, okay, it gains 10% one day, it gains 5% one day, but the growth and loss for these indices are actually referred to in terms of points. For example, often you'll hear on the news that they'll say, oh man, the Dow gained 100 points today. And basically, each point is about $1, 1-to-1 ratio. And yeah, you can see here that the Dow Industrial Average is made up of quite a few well-known companies. You have the Walt Disney, you have Boeing, the airplane company, ExxonMobil, the gas company, AT&T, telecommunications, and they're all quite big and quite well established. Okay, and now we have the S&P 500, the Standard & Poor. This index tracks 500 large U.S. corporations listed on the NYSE and NASDAQ. And something to keep in mind about the Dow and the S&P 500 is that the companies are weighted, which means that um, some companies' movements will affect the index more than others. You can see here that Apple, Amazon, Alphabet, which is Google, um, Microsoft, and Facebook, they make up almost 50% of the um, of the impact of the weight, I would say, of the S&P 500. Next on, we go to the NYSE Composite. So the NYSE Composite is an index covering all stock listed on the exchange, I believe. And it is made up of over 2,000 stocks. Now, something different about the NYSE Composite is that unlike the other two, this index covers both US and international entities. It also includes securities such as ETFs, which I might cover in another video. It's just a different type of security, investment trusts, and closed-end funds. And finally, for our last one, the NASDAQ Composite. So, like the NYSE Composite, it is an index covering over 2,500 stocks on the NASDAQ exchange. So the other one had many stocks on the NYSE exchange, and this one's on the NASDAQ exchange. That's one of those, probably the main difference between the two. And yeah, like the NYSE, like the NYSE Composite, it includes more than just stocks of companies. It also includes ETFs, funds, and other securities. So I talked a little bit about the difference before, or I talked a little bit about the similarities before, how it had like the basic similar pattern. But now you might be asking now, what is the difference between all these? Why can't I just look at one? Well, I'll tell you, each one tracks their respective markets to a different degree. For example, the Dow, it is only made of 30 large, well-established companies, which means that the Dow is more general due to it only being comprised of the 30 largest and most well-known companies. Now, the S&P 500 is going to be more specific because it has a larger database to derive its value from, and it takes in companies from a variety of sectors. So, although the Dow does take its value from 30 companies, 30 well-established companies from many sectors, the S&P 500 is just going to have more because it has more companies from even more sectors. And so, even though the Dow is probably more popular, it's probably the most popular index, fun fact, but the S&P 500 is often regarded as the better indicator for the overall state of the stock market in general. And okay, and then we can talk about the NASDAQ Composite, which has over 2,500 securities to take its value from. And one of its maybe advantages or strong points is that it is more used as an indicator for growth in tech companies for the NASDAQ Composite. So that's just something that it's better at. And for the NYSE Composite, it's good for looking at global diversification because it takes in companies not just from the US. It also has companies from Canada, China, UK, and Japan. So it's a better indicator for the overall world markets and not just the markets in the US. So yeah, I think that's going to about do it for this video. If you liked it, please be sure to hit that like button and subscribe. And yeah, I'll see if I'll make that ETF video at a later date. Okay, thanks. Bye.